LaGuardia, let me go and share the screen. Yeah,
Professor, I have a quick question.
yeah, go ahead.
You said it's only for us. Does that mean only for Do you mean only for college students? There's no class.
So I don't want to cause confusion with the DOE because I've got a kid in pre-K at a public school and they're meeting tomorrow, but they're not meeting on Thursday. So I don't want someone to tell me that, they kept their child out of school because I said there's no school. I'm simply referring to our school, LaGuardia Community College, no classes scheduled tomorrow, no classes on Thursday. All right,
And then
so
would this
go ahead.
be would this be a national holiday, or do you think offices are going to be open for
No,
these
no,
2 days?
no. The offices are open on, or I think the offices are open on campus because it's when it says no classes, just means that classes are not meeting. When
No,
it says that the
I'm sorry.
college, you mean any offices? No, this is
Yeah.
not a national holiday. This is just a Jewish holiday. When it's a
So
national holiday and it says college closed, that means that the country is, in some type of public holiday.
okay, so like regular state offices should be up and running
Oh
these 2 days.
This is just it's Yom Kippur. It's Jewish holidays. So CUNY observes the Jewish holidays, but the rest of
Mhm.
the city, unless you're dealing with specifically with a Jewish business, the rest of the city is open. And all I know about the DOE is that my child is going to school tomorrow, but not on Thursday. So if you have siblings or children and you're not sure whether they're supposed to go to school, just check the DOE calendar. There's a calendar that will tell you what's going on. Yeah, okay. So if you wanted to
Sounds
go
perfect. Thank you, Professor.
to the DMV or something, you can do all of your errands tomorrow and Thursday. Or if you need to catch up on schoolwork, this is also a perfect time to do that because the classes are not meeting. All right, and if there's any concern with looking at dates and things, this academic calendar is where you want to check stuff out. Today, again, just to reiterate, today's the last day to add a course. If you suddenly, found some flexibility in your schedule and you're like, oh, wow, I could take an extra class or something. Today's the last day to add a class, and it's also the last day to change course sections. So as an example, if you decide you're not into this class section, you want to be in another class section, or you want to be fully online or whatever, you can only do that up to today. After today, you are quote unquote stuck where you are. You won't be able to change professors or add any courses or anything like that. Right? So if you still want to drop a class, this is too late now. Yesterday you could drop a 75% refund, but you can still drop between now and Monday and get 50% back. Again, I don't know that this applies to anybody in this class, but I think sometimes they don't always share with you guys, what's happening in terms of what you take plan and perform. Does anybody have questions about the calendar?
Just more or less a comment. I can't even drop one of my classes. I have a science class. It meets every Wednesday, and I haven't even had that class yet.
Yeah, but you don't have to be in. I don't know that you want to drop the class. I'm not encouraging anybody to drop a class. I just, since this is being recorded, I need to make sure that I'm saying that, right? But you don't have to be in the class to drop the class. A class can be dropped in your CUNY First. Where you see your schedule in CUNY First,
Yes,
where you
yes,
can
I
look
know.
for. So, okay, I see what you're saying. You haven't actually even had the experience of the class. Gotcha. Yeah, it's kind of unfair because we start on a Thursday. There's no class tomorrow. Gotcha. Well, God forbid if you in a class that you haven't met yet and you in the class and it doesn't go well, we all still have the option to withdraw from courses right up to December the 8th. Out that won't be the case, but you're right. It's a little bit, this sometimes happens with the fall semester where we have all these holidays at the beginning and it just throws everything off. So good point. Yes.
Hi, Professor. Yes, I can definitely agree with John. I'm having, I think this class is race and communications, and it's supposed to be on Wednesday, but last week we wasn't able to, because class started on Thursday and tomorrow. So I was going to email her just to make sure. to see if we're meeting or not, although you just showed that we're not. So I
Yeah.
guess.
Yeah, professors are not supposed to run classes on days where there are no classes scheduled because it's against the CUNY policy. So I suspect the answer there will be that there's no class. Mhm.
Got it. Thank you.
All right. So a few other things to remind people. Yesterday was the day that I was asking everyone to create their Wiley Plus account due at 6 p.m. I didn't go through at 6 p.m., with a red pen to make sure that everybody did it. This was more something as an incentive to say, please make sure you did it. I will check after class today again to see if there's anybody who is not yet on Wiley, and you'll hear from me separately. All right. You're not in trouble if you didn't. I will tell you in the class when you're in trouble, in the sense that you are falling behind. You're not in trouble yet if you haven't created the account, but I encourage you to do it today. There's no reason that anybody should not be in Wiley because you're getting it for free this semester. So, there's no issue with not being able to pay or grace period or anything like that. Your personal biography, which is on the discussion board, and the assignment is listed over here on the assignments list, right over there. That's due tomorrow at 6 p.m. Since you guys don't have class tomorrow, if you haven't done it already, maybe just take a few moments and finish the personal bio. And then, as I said, on Thursday, we have no class. And then the first homework due date, and hopefully people are marking their calendars. I know this sounds like it's far away because it's 2 weeks away, but remember the homework is already available on Wiley Plus and you can start doing it. You don't have to wait until the due date. So I will just demo. I know a lot of people have already been in and you probably started the homework already, but just for the sake of keeping momentum in the class, I'm just going to go into Wiley again and go into the student view and make sure that people know where to find the homework. So this is our class. You'll be able to join Wiley for the class via the textbook information tab. There's a URL there. Let me see how I can help myself here. Okay, so the student view, this is what you see. You have readings. If that's just parts of the textbook that I'm saying these are relevant, or there's solution walkthroughs and stuff. And then this is the homework. It's, out of 10 points. Sorry. And once you click on the homework, you can start. You can see that it's unlimited attempts in this homework, but it is due by September the 28th. All right. So you can see it's been available, since last week. So please, spend some time trying to get yourself acquainted with that. And just as a reminder, don't sleep on the homework. Okay. Each homework is going to be worth 5% of your overall grade. So, you don't want to just be like, I'll just put it off or whatever, because it will actually, 5% is already the difference between an A and an A minus, or between a pass and a fail, and so on. So please try to get going on the homework as soon as possible. We'll continue with examples today that will help you be able to complete the homework. All right. So again, the main things that are coming up: finish your personal bio. I'll be reading them. Start looking at the homework after today's meeting. You'll have more tools to be able to answer the questions. Okay, it's fine. Right, so any questions about the due dates or Wiley class or homework, anything like that before we get back into the partnerships work?
I started reading and I had a question about something that was in the textbook.
Okay, so so you can stick. We'll have a break here. First of all, I might go over it today anyway, but if it's not, hold your question. As soon as I have, there's like a 10-minute break that I might do at about 11:30. You can ask me the question, or otherwise, you know, if I come to the part of the material where your question is, then just stop me and ask me the question. All right?
Mhm. Okay, thank
Okay.
you.
Okay, no problem. Right. So last time, when we were together, we started going over, you know, I guess a lot of the theory around partnerships. I'm not going to repeat that. And like I said, this page that I'm looking at, if you wonder where you can find this page, if you go to Blackboard under additional notes and exercises, everything that I'm looking at is right here under chapter 12. All right. So you can download it for yourself if you want to. You can even print it. There's no requirement to do this, but if you want to, you can print it and write on the notes and so on. Right. So we said that a partnership is, you know, some association, meaning, you know, just a getting together of two people who are going to be in business together. The business is, you know, the nature of the business is that one partner can act on behalf of the business, which then, you know, implicates the other partner. So you want to make sure that you're going into business with the right person. A partnership will end if a partner decides to withdraw or passes away or there's some incapacity. So it's not like a company that just continues in, you know, as a going concern. A partnership actually has a limited life. Partners have unlimited liability. So their personal assets could also be taken if the partnership doesn't have enough assets to cover its debts. And then the partners also own the property together. So last time we saw, and I'll revisit it here in a second, we saw partners Rolf and Shay were contributing to the partnership. And what we then realize is that once those assets get contributed to the partnership, they belong to both partners. You can't say, oh, well, I gave this office equipment, you know, when we started the partnership. So now that I'm leaving, I want my office equipment back. It doesn't work that way. The partners have to, if the partnership is liquidating, if someone's leaving, they have to basically sell all the non-cash assets and split the money between the partners. All right. So there's once you put your stuff into the partnership, it's not yours anymore, it's everybody's. Then we also said that it's important to have a partnership agreement, especially when we come to the second part of the work that we'll be doing, which is dividing net income and loss. If you don't have an agreement that says how to divide the money between the partners, then everything goes 50-50, profit or loss. And, you know, if you're the one doing the most work in the partnership and the other person is kind of just like a quote unquote silent partner, it won't be helpful to you if they're just getting 50% of everything, if that's actually not indicative of the level of I guess input that everybody's making. So partnership agreement is important, and one of the most important parts of it is what it says about how the profits are going to be split. And then we spoke about you know, other different types of partnerships, which you can read about in the textbook, like limited partnerships, LLCs, and limited liability partnership. So, you know, that's kind of like the 20,000-foot view of the theory that we went over. We don't need to rehash it. I just know that between Thursday and Tuesday, you know, a lot of things happened, a lot of time passed. So I'm kind of just getting us back into the zone. And so, oh, so ladies asking, if you start doing the homework, do you have to finish it the same day? Absolutely not. The homework is not timed. The homework is open from now until the 28th. You can go in and out, back and forth. It's unlimited attempts. So you don't have to worry about, oh, if I start now, I have to finish it within the next X amount of time. That applies to tests and quizzes. You do have to finish those within the time allocated. All right. So basic partnership accounting, you may recall from Thursday, I said we will have 4 things that we need to be thinking about, and I guess different categories of partnership accounting that we're dealing with. The first one is forming the partnership, which we kind of touched on Thursday, right near the end of the class. Then you've got dividing the net income and loss between the partners, right? How are we going to make sure that everybody gets what they're supposed to? Then we'll look a little bit about partnership financial statements. And last week we talked about, you know, what are the different financial statements and what goes into them. And then the last piece was liquidation of a partnership, right? When we're coming to the end of the life of the partnership, how do we close out the books? And so if you recall from our discussion about forming a partnership, a critical issue that you have to remember is that all the assets that go into the partnership are not recorded at their historical cost that you paid for them once upon a time. They are recorded on the date of the contribution at the fair market value. So fair market value, a few of you, gave your input and said fair market value is basically what you can buy or sell something for in the open market today, right? So basically what it's worth. Book value, we spoke about book value is what the thing cost some time ago minus any accumulated depreciation. Accumulated depreciation being the amount of money that is showing how much of that asset has been used. So what do we take, fair market or book, fair market value or book value? It's always fair market value that we will use, one. And then the second thing is we have to remember that we are the accountants of the partnership, not of the partners, of the partnership. So when the partners contribute money into the partnership, we have to record those transactions as if it is the partnership's books, not the partners. I know this, I'm being like a stuck record, but to be sure that you understand that when you're looking at what's coming in, it's like you're sitting at the partnership, the partners are giving you whatever it is that they are contributing, and you are recording it on behalf of the partnership. So don't worry that when someone gives $9,000 of a cash contribution, that partner has less cash in their wallet. It doesn't matter. You're recording it. You're recording it in the books of the partnership. I'm checking the chat from time to time to make sure that people are not needing me. I'm not sure, Abdus or Sam, is that what you go by? I'm not sure if you're asking me. Are you saying that you weren't allowed to go back into the homework again, Sam? Yeah, that's very strange because I made it unlimited and it's wide open. So I'll look to see what the problem is. In fact, I can do it now because we can see what it will say about the policies. Unlimited attempts allowed per question. So if that's the case, you have to be able to go in again. I think what might be happening is that you need to clear the cache. Sometimes this happens with Wiley, that if you clear the cache on your browser history, then you'll be able to get back into Wiley. But as soon as an assignment is unlimited attempts, it means that you can go in and out for as long as the assignment is open. And this assignment is open, I'm not sure why it's open until 8 p.m. now, but it's supposed to be open until 6 p.m. on the 28th. Yeah, I can look at your thing, Sam. Let me look at it during the break or at the end of the class, okay? Or you can send me a copy of the error message that you're receiving, so we don't, we don't take up too much of the class time here. So looking at the example that we had before, right, just to refresh our memories as we go into, the next few examples. We had two partners who started a partnership. One was Rolf and one was Shay. Rolf gave 8,000 in cash, and you guys rightfully told me that cash, 8,000 cash, that's the fair market value of the cash. Rolf also gave office equipment with a cost of $5,000 and $2,000 accumulated depreciation. So now if you think about what we just said, we don't use cost and accumulated depreciation because we don't use book value. We need to find market value or fair market value. So we can kind of ignore this information. It doesn't matter. We're looking for market value. So when we read further, we see there they give us the market value of the equipment is 4,000. And please note that the question has to give you the market value. There's no way that you can figure it out on your own. So just keep reading and you should find the information that you need. And then Shay gives cash of 9,000 and accounts receivable of 4,000, which is also an asset. And then there's an allowance of 700, and we discussed that both partners think that the allowance should be 1,000. And at the time, when we were answering this, we said that for Rolf, you debit cash for 8,000 because cash is an asset and the cash of the partnership is going up by 8,000. Office equipment, we took the market value of the office equipment at 4,000, and that was also a debit because it's an asset, so it's increasing. And then we said you cannot only have 12,000 in debit, the dollar amounts of debits and credits need to balance. So we were missing 12,000 on the credit side, and that goes to capital because we said the books of the partnership have to show that the partner, Rolf, has a stake in the partnership worth $12,000, right, at the date of formation. Questions up to there about this piece of the formation entry or any of the theory? Okay. Let me see. I don't know if this is a question about the material. Okay, so yeah, Sam, I'll sort your stuff out at the end. Thank you. And so for the other partner, Shay, they gave 9,000 in cash, so it's a repeat, right? Debit cash, it's just a different amount, 9,000. Accounts receivable is also an asset. Again, remember, asset is anything that the company owns or controls that they'll receive future benefit from, right? The future benefit could be in the form of cash or in the form of the use of that asset. Cash is an asset because you can use it in the future to buy stuff. Accounts receivable is an asset because you'll collect cash from your customers. So you record the entire 4,000 because that's what's owed to you. But then there's a doubt, right? Allowance for doubtful accounts. There's a doubt about $1,000 of this 4,000 that may not be collected. It's not a fact, it's just an estimate. And we said that the allowance for doubtful accounts is what we call a contra asset. It gets netted against the accounts receivable in the balance sheet. So you would show accounts receivable, then you show the allowance, and you end up with what they call net receivables, often on companies' balance sheet, net receivables of 3,000. The message that the company is sending someone who's looking at it is, this is what we expect to collect, but there's a doubt about 1,000 of it, so we may only collect 3,000. And that's done so that the company does not overstate their assets, right? Overstate meaning you're saying that the asset is worth more than what it actually is. So 1,000 goes into a contra asset. A contra asset is an asset, but it increases on the credit side. So this is the nature of accounts here, a little bit tricky, a little bit weird, but there is such a thing as a contra asset, also such a thing as a contra liability that we'll see, later on in our time together. So it increases on the credit side. So you've got 13,000 on the debit side, and at that point it was 1,000 on the credit side, so you still need 12,000 on the credit side so that the dollar amounts of debits and credits can balance. It doesn't have to be the same number of accounts, right? Here you've got 2 accounts and here you've only got 1, but they balance in terms of dollars, right? So now you've got 13,000 on this side, 13,000 on that side, so the journal entry is complete. Any questions on that? Because guess what? Next, you guys are going to do one on your own. So anybody have a quick question?
So why did they give us the information that the allowance for doubtful accounts was 700 before?
Yeah, one, to test, well, I guess only for one reason, to test whether you understand that as part of the rules of formation, that the partners have to agree to the amounts that they are recording, one, and the partners have to agree on the fair market value of the assets. So they are trying to see if let me go back here, right? Here it says, all partners must agree to the values assigned. Do you see where I'm highlighting that?
Mhm.
And so in the question, Shay thought thought the allowance should be 700 coming out of their previous business, but the partners agreed that the allowance should be 1,000. So this is a typical example of where the principle of the accounting principle meets practice, where you have to know that you should be recording the number that the partners agreed on. And so it's like a typical question, just testing to see if you know which number should go into the books.
And can you remind me, you said the assets are, like, can you go back to the other page?
Mm-hmm. Are you talking about this?
So you said the cash and the office equipments are being debit, and then the
Yeah.
owner's capital is being
Yeah.
credit.
Yeah.
Why do we know it's the owner's capital?
Because if you're thinking about the transaction, right, all of this goes back to what is the transaction that is happening. So now I'm like back in like chapter 1, right, of accounting 1. So transaction analysis, the owner, if you think even back to your accounting 1 days, the owner invests cash in the business, right? So what is the transaction for the company? You're receiving these assets. I'll use the partnership as an example. You're receiving cash and office equipment. So the assets of the company are going up. But a transaction has at least two parts, right? There has to be something else that is happening. And so the question then becomes, what else is happening? Well, if someone is contributing to the partnership also as to show that the assets were contributed into the partnership, but they also have to show essentially who those assets are attributable to, like who they quote unquote belong to, like who gave them. And the way to show that is to increase the capital account of this partner, because let's just say the partnership ends tomorrow, right? If the partnership ends tomorrow, each partner would want to get back what they put in. And so the only way to know that is for there to be a capital account for the partner on the books of the partnership to show how much their investment in the partnership is.
Oh, okay. Yeah, I don't
Are
know.
you
I got a
following?
little confused.
Let me ask you
Yeah.
this. Let me ask you a different question.
No, that I
What do
understood,
you?
but
Where do you think it? Where did you think it should go? What other options do we have for the credit? This is not a trick question. I'm just saying, like, what other account do you think we could have credited? So I can help you to see why it
No,
wouldn't.
I understood. It just that before class started, I went over the liquidation of partnership.
Oh, well, that's
So
yeah.
over
That's the
there, they
opposite.
take
Mhm.
whatever like assets happen, and then they
Mhm.
like they give it to owner's capital.
Oh yeah, you're at the end. This
So
is the
it's
beginning.
like,
Opposite. That's the opposite because you're
it
paying
got
the
me
people.
confused.
Yeah.
Does
You
it
got
make sense? Why I am confused?
Yeah, because I'm at the beginning and you were at the end. At the beginning, we increase the assets and we increase the partner's capital account. It's like if you went to the bank and you go deposit money, right? Your bank
Yeah.
account increases. At the end, when the partnership ends, we're taking stuff out, taking away from them. So it's the opposite. And I can see why you would be confused. But if you think about it as this is the start where we're putting stuff in and we show that we have, as a partner, we show that we have an investment in the partnership. At the end, I'm selling everything and I'm taking my money back to show that I no longer have an investment in the partnership.
Yeah, I guess
Okay.
it will make sense later.
Yeah, I mean, it's the key here, and I'm going to say this a lot, and this is kind of like my mantra with accounting is practice. It's
Yeah,
people
I
think
didn't
that,
get to the practice
Yeah,
yet, so it's
it's-
all like a
we're
big
gonna-
mess right now.
yeah, don't worry, it will become clearer. There's practice to be done. There always is, and I also, I think that you just have some compassion on yourself that everything doesn't necessarily stick the first go around. That's why we need to practice. Okay, so thank you for asking that. I think as you do an example now of, for formation, maybe it will become clearer. Okay, guys, so this is
Thank
what
you.
we're gonna, you're welcome. This is what we're gonna do now. This example 2, this Jay Stevens example, I'm going to read it with you and talk through some of the concepts, but then I'm going to leave you for about 5 or so minutes to actually try to do the journal entry yourself. Okay, so this is how my class usually runs. I can't just talk and do all the examples and then at the end nobody knows what's going on. You also have to put pen to paper. So if you don't have a pen or paper or something or a screen or something to write on, please get yourself situated so that you can practice, because this won't be the only time today where you'll have to try and do journal entries. So example 2, Jay Stevens and E. Foster agreed to form a partnership. So those are the 2 partners. Stevens contributes land, so that's an asset that needs to be recorded at fair market value. Inventory, same thing, needs to be recorded at fair market value, and $24,000 of cash. So cash is already at fair market value, so that's the number that you're going to be recording. The land had a book value of 65,000. Can someone tell me, raise your hand or shout out, it's okay, or maybe just raise your hand. Somebody raise your hand and tell me whether we should be including book value in our journal entry. Yes, Michelle. Thank you.
No, we shouldn't.
No, we should not. What should we include instead, Michelle?
The fair market value.
Thank you. So
Mhm.
there's your number, Michelle, market value of 114,000. The inventory had a book value of 60,000. If we go by Michelle's rule, we ignore the 60,000 and instead use the market value of 56,000. Now someone's going to say, but why do they put these numbers in when we don't need them? Because you are being tested to see if you understand the rule that market value is what you use and not book value. The partnership also assumed a $50,000 note payable owed by Stevens. Can I get another hand for someone to tell me what is a note payable? Or what type of account would a note payable be?
Liabilities.
Liabilities, okay. So it seems that one partner brought a liability with them. Does that seem weird to you? No, maybe?
That does to me.
Yeah, who's talking? Sorry, I can't see.
Anissa.
Okay, yeah, so to be, so maybe it's a little bit weird because you're like, why would a partnership assume a liability? But remember, this is the same partner that brought land of 114,000. So most likely the note payable might be attached to the land, or it's just debt from the partner's previous business. Okay, so now the question becomes, whose liability, right? Whose liability is it anyway? Is that liability going to be recorded in the books of the partnership or not? Can I get a hand raised? Someone who wants to tell me. You have 2 options, record it or don't record it. So someone raise your hand and tell me whether you think we should record the notes payable or not. Yes, when?
Yes, we should.
Yes, we should. And do you think you should debit or credit the notes payable?
Debit? Credit?
Credit.
Definitely credit. Yeah.
It's a liability, right? Liabilities, I just want to check, no one can hear a lot of, no one, this is as an aside, you can't hear anybody mowing the lawn on my feed, right? Because I think I'm canceling the noise. Is that correct? You only hear me talking?
Yeah, we only
Yeah,
hear you,
only you.
Professor.
Okay, great. That means my software is working because I can barely hear myself speak because the neighbor's lawn's being mowed. Anyway, not your problem. I just want to make sure that it wasn't disturbing the class. So the 50,000 note payable is going to be taken on by the partnership. When liabilities increase, that is going to be a credit, right? Let me go back here. I think this is worth showing again. If you go to course resources, you can, I guess the book is not, let's see. I wanted to access the textbook, but it looks like there, something's wrong with why you, maybe I just need to leave the student view, just 1 second, yes. Okay, so I think one person emailed me to ask me about accessing the textbook. You have to go under course resources. It's not very intuitive. I don't know why they did it that way, but you can access the textbook without, paying for anything or anything like that. Why am I here in chapter 2 when this is not part of our work? Because I just want to make sure that we are keeping to, I guess, the basics here. So assets increase on the debit, decrease on the credit, liabilities increase on the credit side. A note payable is a liability. It's going to go up on the credit side, right? So we've talked it through now, right? There's land, inventory, and cash. You're going to use market value, not book value. And then you have a $50,000 note payable, which was telling us it's a liability and that we should credit it. So I'm going to leave you guys now until 11:20, probably more time than you need, but until 11:20 to prepare the journal entries for Stephen's investment in the partnership. Okay, and when we're done, someone who hasn't spoken yet today will tell us what the journal entry is.
I'm sorry, Professor. Your mic was moving, but I didn't hear anything you said.
Okay, my bad. How about now?
Yeah, I can hear you now.
Thanks, Sam, thanks for the heads up. Sorry, I thought I was on mute by accident. Anybody who wants to, go ahead, raise your hand, someone who hasn't spoken yet today to give us this journal entry or part of the journal entry. Okay, is it Scarlett Pacheco?
Yes, Scarlet.
Okay, nice. Is it Scarlett?
Yes.
Okay.
Scarlet.
Okay,
I'll say cash, 24,000, debit,
okay, bear with me because I'm gonna write it on the spreadsheet on your screen, okay? So you're gonna debit cash. With how much?
24,000.
Professor, your mic sounds like muffled. Do you mind fixing that for a second?
I wonder if it's, the mic is through the computer, so I don't know.
You kind of sound like a robot for a second, that's why.
Okay, hold on. Okay, I'm using a software that's canceling outside noise, but there's so much outside noise. I don't know if that's what's causing the problem. How do
Well,
I
no,
sound?
You
it's
sound
perfect
perfect.
now. Perfect
Yeah,
now.
you know what the problem was? I think I was telling you that, I mean, it's insane, like they're busy mowing lawns like right under the window. And I think the software was working so hard to try to muffle that noise that it basically muffled me. Sorry about that. Okay, so Scarlett, sorry for the interruption, and thanks guys for letting me know that there was a technical problem, and always feel free to just interrupt because you know you need to be able to hear me and I need to be able to hear you. So cash debit 24,000, perfect. What's next?
Land for
Land. Mhm.
114,000.
Good, so you decided on, as you know, we said market value, not book value. Next.
Inventory, 56,000.
Yep. Inventory 56,000. Continue.
Well, now this was tricky, but I'll try.
Mhm. Do
Payable,
it.
payable, credit,
Yeah, yes, you're on the right track. Notes payable, 50,000 credit. Mm-hmm. What's
capital, 100,
Stevens capital? Okay.
$144,000.
So how do you come up with that? It's correct. So first of all, you're correct, but how do you come up with that number? Can you tell the class how you
Yes,
figure it?
I added all the debits and I subtract the credit.
Right. So we know that dollar amounts of debits and credits need to match. And so we know that on the debit side, there was 194,000 and we only had 50,000 on the credit side initially. So that must then mean that the capital account has to be what we call a plug number, or you solve for the number of 144,000. That's correct. Thank you so much for answering it. Any questions on this
Yes.
journal? Go ahead.
So basically, what she just said is that she added the 24,000, 114,000, 56,000, then subtract the notes payable to get 1,444. Okay.
I'm just writing it here in case we spoke too fast for anybody. So it's a plug number. We sometimes refer to it as a plug number. You kind of have to balance out the journal entry to get to the number, because we know the rule that debits and credits have to be equal. Great. Any other questions on this? All right, so let's some, this, I'll post a link to this document, but I also just want to remind you, I mean, not that you should be, not that you should be using this to answer the questions, but all the solutions are already up on Blackboard. I want to make sure that people actually try on their own. So don't just use the solution. I don't think anybody will, but just in case you feel like you missed something and like, I don't know what the answer to that thing was, the solution's already there. I'd like you guys to go ahead now. I'm not going to do any detailed reading with you. I'm just going to let you read this example 3 for yourself and then try and see if you can answer the journal entry. And I think I had a volunteer that put their hand down, but Shafak, if you want to, I think I got your name right. If you want to, when the journal entry time comes, you're welcome to answer. So, all right, so you guys have another, let's say another 6 minutes. You have until 11:32 to do example 3 by yourselves. But you can ask questions if you want to. All right, there's a minute to go. Again, want someone who hasn't spoken today to answer. So you can raise your hand when you're ready to answer. All right, so a volunteer, please. I don't want to put Shafak on the spot, but I know you wanted to answer the previous one. Do you want to answer this one?
I can try, but I know I don't know the whole thing, but I can
Yeah,
start.
but you could start us off and somebody else can pick up if they want to. As
Oh.
long as you feel comfortable. Are you comfortable to start it?
Yeah, I'll give it a try.
Yeah, great.
So the land is 15,000.
Okay,
Debit.
just bear with me. I should have done this already, but I didn't. Okay. So land, are you saying land is 150,000?
Oh, can you start your question? Sorry,
Oh, yeah. Sorry, you can't see the question. Yeah, so that's cash of 15,000.
Oh,
Did
so
you,
the
did
land,
you? Mhm.
the land's value is 150,000
I think
market value.
I think you just swapped them around, yeah. So the question said that this partner contributes land divine, right? With a book value of 65,000, but we already know from previous discussions that we go with the market value. So you're saying debit land with 150,000, that is correct. What do you want me to do next?
And then Drew contributed $10,000 cash. The cash goes in debit.
Okay, so what I'm gonna do is separate them out. And I think this is maybe why you said it was difficult. Let's do everything for divine first and do that journal entry for divine and then do Drew second. How's that?
Okay.
Do you want me to do it? Or do you want someone else to take over?
Yeah, someone else can
Yeah,
take
no
it.
worries. Who's gonna, yes?
Denisa, would it be cash 15,000?
That's right. Thanks for helping out. So cash 15,000. So
Yeah.
to anybody who might be, just hold on one second, anyone who's confused here, we're gonna try and split these partners up. Otherwise it becomes a bit confusing to know what the balance should be on the capital account, right? So so that's why we are saying, okay, let's just deal with divine completely and be done with divine, and then we will deal with Drew. Tanisa, what's next?
Okay, so then now here was a little bit tricky because I thought of back to our first example where we had accounts receivable and allowance. I'm not sure if that's something we have to add in right away, where
Okay.
we had, for example, subtracted where we had 4,000 subtract 1,000 to figure out the allowance. I'm not sure if that's something that we have to add right away or after.
Well, the partners are starting the partnership. I want to make sure I'm understanding your question. Is this something we should, are you saying, is this something we should be recording right now? As
Right.
part? Yes, because because accounts receivable is being contributed to the partnership with the allowance for doubtful accounts where they're saying that
Okay.
we're not sure we're going to collect all this money.
Okay, so then the account receivable will be 32,000.
Debit,
Sorry
right?
for my background.
Sorry.
I said sorry for my background if you're hearing
No,
the,
it's fine. I mean, I'm the one with all the grass being cut. Not that anyone can hear it, but it made me into a robot. So we just have to deal with whatever is happening in the background.
right,
And then what are you gonna do with the allowance?
you're gonna credit it for 2,000.
Okay, so we're back to this notion that allowance is a contra account. What did it say in the question? It said that the accounts receivable has a balance of 32,000 with an allowance of 2,000. This differs from the previous question because in the previous question, there are two numbers for the allowance, right? And
Right,
the partners agreed on 1,000. Over here, the question is silent, so you can assume that the partners agreed that 2,000 is the correct number. All right, so you don't have to worry about, is there some other number that you should be recording? What
Okay.
now?
and then so after that, I was thinking of starting with um the second partner,
Mhm.
if I'm mistaken.
Yeah, so you can make your life much easier here if you want to, and you can actually just finish the first partner and do the second partner as a separate journal entry. You can combine them, but then you kind of have to flag which assets belong to which partner, because then afterwards you won't be able to know how to calculate the capital account balance. Do you understand what I'm, like if we just start adding the next partner on, then eventually we're not gonna know who contributed what to
Okay,
make
so
sure that
then-
the capital, so what I recommend is that you go like this, you say divines capital over here and actually just balance out this journal entry to finish it up.
Got it.
So what do you guys want to put, or what do you want to put here? Oh, well, I guess you went on to the next person, so I can, you went
Okay.
on, okay, let me ask Michelle, I saw your hand up. Do you want to take this, on? Or you were the second person whose hand went up, but then you kind of disappeared. I didn't know if you
Oh
wanted
yeah, I
to.
had a question earlier.
Oh, go ahead, sorry.
It was just like as far as the layout, I had it the opposite way, but I just wanted to know if like if
What
it makes a
do you
difference.
mean by the opposite ways? The credits were
As far
going
as-
first?
No, as far as like I had cash and then I wrote
Oh,
out.
doesn't
my-
matter. So what's the,
Okay.
no, that's the only rule that we have in accounting. It's a little bit arbitrary, but it is a rule, and it probably, and Wiley also follows this, is that debits go first and credits go second. And some of this is because, debits are to the left of the T account and
Right.
credits are to the right and get indented and all of that. Does it matter the order of the debits or the order of the credits? Absolutely not. Sometimes we just write them in the order in which they appear in the question, but at the only time I think that Wiley will question what you're doing is if you start mixing the debits and credits together, and not listing them, first debits and then credits. All right.
Right. Okay.
Okay.
Yeah.
Who wants
So-
to, go ahead. Sorry, go ahead, Michelle.
Oh no, the capital is 195,000.
Okay, yeah, 195. Okay, I didn't realize you wanted to answer this. So how do we know that? Thank you for answering that. How do we
You're
know
welcome.
that? 197 on the debit minus 2,000 on the credit gives us 195. It's a plug, right? You have to, or you solve for the number. You can't just know the number, somehow from the question. You got to add and subtract, right? So I know at the risk of being a stuck record, people like, yeah, we got this, you really need to tell us this again, but just in case someone was, asleep or looking at Instagram or something, that's how I got that number, or how Michelle got that number. So I can't remember now in the homework if they expect you to make the whole journal entry and then and then have the partners at the end. I'll do that for you as well for this example, but let's just finish. What's the other person's name? Sorry, Drew, right? Let's finish Drew. C, did you want to try Drew or someone else whose hand was up?
What to do the other partner, you mean?
Yeah. Did you want to do that? Okay, go ahead.
So we debit cash for 10,000
Mm.
and we debit equipment for 5,000.
Which is
And-
the fair value, right? Not the book value.
Yes.
Uh-huh.
And that means that we're gonna have to credit the capital for 15,000.
right,
which is 10,000 plus 5,000.
correct. Okay, so that's the split entry. That's what we could do. Here goes the complete compound, right? So that's split, and I'm gonna say or, right? So you know you don't have to do both. Or you could do everything together, which was what Denisa was talking about, but it gets a little bit rough because you have to know, you know, who contributed what. So if you're gonna do everything together, that's what we'll call this journal entry, right? This is the everything together journal entry. You will put basically, you know, you can start. I don't expect you guys to do this. I'm just going to move quickly through it. So you put land, you can put the two. People were kind of saying, okay, let's put the cash for one and then the cash for the other one, right? Because those two, you know, accounts are the same. You can put, let's put the equipment first, right? So you're kind of just mixing it all together. And then we put the accounts receivable, but notice I'm mixing the two partners together, but I'm still putting all the debits first. And then the allowance is the other balance that I know, you know, the amount for. Now the tricky part is that I'm going to have to credit Divine's capital and I'm going to have to credit Drew's capital, but I don't know what those numbers are, because I won't just be able to plug the number or solve for it like I can in the regular, you know, individual entries. So we can see that Drew has less going on. So or we go back and say, okay, so Drew gave $15,000 worth of stuff. So obviously Drew's capital should be 15,000, right? So you're just looking for the person who's the easiest, I guess, right? It's a 10,000 of cash plus the, the 5,000 of equipment. And then what you can say now is, okay, you can calculate everything again for Divine, or you can just say on the debit side, we have 212,000, right? And then we have to subtract from that these numbers over here. So it's going to be 212,000 minus 2,000 and minus 15,000. And we should be coming out to the same number that we had before, right? Someone can check the math, but it should be 195,000. So that now the credit side is 212,000 and the debit side is 212,000 as well. Now that's, you know, an entry where everybody got thrown together, but you have to be very careful about, you know, these numbers for the partner's capital, because you can't, you can't just necessarily figure them out really easily. Drew was a little bit easier because it's just two things that they gave, but Divine, you know, you kind of have to do some math to get to the right number. Questions on these two different approaches to basically the same formation journal entry? I see some hands are still raised. Do you guys have questions, or do you want to put down?
Oh, no question.
Okay,
Just
no
the
worries.
accident.
No, it's fine. It's easy to forget to put your hand down. All right, so let that sink in. Let's take a 10 minutes here until 11:55. We're a little bit late on the break because I just wanted to finish the formation journal entries. We take 10 minutes until 11:55. When we come back, we're going to move into dividing net income and loss between the partners. Able to be, you're just a viewer, okay? I can't make you an editor, otherwise everybody will be trying to do the journal entries along with me and it will be total chaos. So you guys should only be viewers. Denisa, are you asking me something? You have your hand up?
Oh, no, I do. I'm sorry, Professor.
No, it's fine. I just want to make sure because we're coming back from break and maybe you had something to ask me. All right, let me actually also just stop the share and make sure that I have the full attendance for everybody. so that there's no issue with that. Just bear with me. And Michaela, are you're still on the call? Just if you can at some point, just paste that WhatsApp link again so that anybody who came late to the call, if they sometimes when you come late, you can't actually see previous chats. Okay, that's, if you could paste it again, I'd be grateful. All right. So again, that's the Google Doc. So we're done with formation of partnerships. Not done in the sense that you'll never see them again, but the next time you'll really be hitting anything up is on your homework. What I will say is that the maybe 3 key takeaways that will make your life easier is always record at fair market value, not book value with depreciation, right? So the fair value of the assets is what goes in. Number 2, allowance for doubtful accounts is a credit, right? It goes up on the credit side and you put the amount that the partners agreed on. So that's another thing to remember. And 3, we learned with the notes payable that partners can, or the partnership, excuse me, can assume the liabilities of partners. You will just credit the partnership liabilities. It's not a problem. Make sure that you are recording it at whatever amount is given in the question. And I guess I'll just add for number 4, more often than not, you have to solve, for the partner capital amount. And again, we record capital because we're showing that the partner invested in the business. You may be called upon, I can't remember all the Wiley Plus questions, but you may be called upon to do a big journal entry where all the partners are thrown, together into one thing. Just remember the rules with journal entries, put all your debits first, then you put your credits and you can solve again for the capital balances. And you have unlimited attempts on the homework, so you can keep trying, you can, get hints or whatever from the textbook. Okay, so that's the end of formation. So let's talk a little bit about dividing net income and loss. So if there's no partnership agreement, then net income and net loss is shared equally by the partners. And by net income, we just mean revenue minus expense plus any gains minus any losses, right? The last number on the income statement. So if they did well, they had an income, otherwise they have a loss. The loss even has to be shared. You can't say, oh, it was a loss, I don't want it. You have to take your piece of the loss, regardless of whether you can afford to or not. If there's no partnership agreement 50-50, or maybe the partnership agreement says 50-50, otherwise there are other income ratios that are stated in the partnership. Now, ratio is just one number in relation to another. So, a ratio could be 60-40 or 6-4. So here's an example. This 6.4, right, might look weird. All that is just saying is you get 60% and I get 40%. Whoever, I'm just you and I'm just assuming 2 people. So 60, so 6 is to 4, or 60% also calculates as 6/10 and I get 4/10. So yeah, in this work, we kind of have to make sure that we have our fractions and our percentages, that we're okay with working with that kind of thing, because we're going to get questions where we have to split money between people using a percentage or using a fraction, and you need to know how that works, right? So these ratios can be given in a question as percentages. They can be given as one number in relation to another. They can even be shown as fractions, right? 2/3, 1/3, whatever. So the net income that is the ending number on the income statement could be split in a fixed ratio between, these partners. So you know, it's maybe I get 70%, you get 30%, and that's it. But there are also other ways that they can decide to split the money. They could say that the ratio, well, this is just saying how the ratios are calculated. Sometimes they can be calculated based on capital balances at the beginning of the year or average capital balances. I have to be honest, for the most part, with our questions, it's just some type of percentage fraction or, you know, a number in relation to another. Now, there are other things to consider. It's possible that partners also get salaries, right? So if they work in the partnership, it's not just a split of the profit at the end. They may also be entitled to a salary. So it's, if there's a salary, that will be allocated first, right? And then anything else, if something is left over, might be on a fixed ratio, like 50-50 or 60-40. It's also possible that partners may get interest on their partner's capital balance. So it could be, you know, you want someone to join a partnership, they're not that excited about joining it, or, you know, they're kind of like, well, what's in it for me? And you might say to them, well, in addition to any profit sharing that you're getting, we'll give you a 7% a year, like 7% annual interest rate on your capital balance. And why? Because people can do many different things with their money, right? If you have extra money, I'm not talking about your emergency fund or money that you need for your rent or whatever, just extra savings that you are thinking about investing, you have many options on what you can invest in, right? You can invest in stocks, you can invest in bonds, you can invest in cryptocurrencies, you could invest in real estate, etc., etc. There's so many different things that you can invest in, and you could also invest in a business. Right. But if someone had to come up to me and say, oh, will you invest in my partnership right now? I might say to them, well, you know, if I put my money into the stock markets right now, it's returning such big returns, it's actually looking a bit more attractive than the partnership. So I'm not interested in putting my money with you at the moment. Then they might say to me, okay, so what if we give you, you know, 6%, like, you know, just 6% on your capital balance before you even get any profit share as an incentive, right, to give us your money. Then I might say, oh, that sounds a little bit more interesting. So it's possible that partners get salaries because they work in the business. It's also possible that there's interest that is being paid to them, almost like to lure them to the partnership or to give them some guaranteed return. And it could be all of the above. It could be that they get salaries, that they get interest, and that any remaining profit is split between them as well. Remember that a partnership is what we call a flow-through entity, meaning that any income that the partnership has to be split and given to the partners, because the partners will be taxed on that money in their individual capacity. All right, it's not the partnership. The partnership doesn't get taxed. So we will have to split the income in the net income or net loss between the partners and then actually allocate it to their capital accounts. Questions on the ratios or the salaries and interest stuff that I just discussed before I move on to something else to talk about more so. Okay, so for now, we don't have questions, or people are so confused that they don't even know what their question is yet, right? So don't worry, we will work through this together. So now the way in which we actually, well, let me take a step back. The first part is that you do the calculation, right? Let's say we have $100,000 of net income at the end of the year, and the partnership agreement says we split it 60-40. That means that you get 60,000, I get 40,000. That's the split, all right? But that's just a calculation in, you know, on a piece of paper or whatever. We still need to actually show that that number ends up in the partner's capital account. Right, we still have to do the journal entry to allocate those funds to the partners, whether they be income or loss. So, surprise, surprise, right? Because you missed it so much, We will use closing journal entries, which you may or may not remember from chapter 4 of accounting 1, which, you know, I'm sure for many people it feels like ages ago. We will use closing journal entries to allocate, excuse me, the income or the loss to the partners. So let's see what this says here. The partnership recognizes each partner's share of net income or net loss through closing entries, and the closing entries are as follows. We won't be concerned with closing off revenue and expense. That's not really the issue that you know that we're concerned with here. We're really more concerned about these last two journal entries, specifically. Sorry. When we come up with a net income number, we want to be able to send that money to each partner's capital account, right? And if you recall, capital increases on the credit side. So, you know, when we split the 100,000, 60,000 to partner A and 40,000 to partner B, we will actually have to credit each partner's account with their portion of that net income. And then the question is, where does the debit go? You may recall this account income summary, right? It's a temporary account that kind of makes this cameo appearance to be used as part of closing entries and never to be seen again. Okay, so income summary is the account where we summarize, right, the difference between revenue and expenses. So in other words, we're summarizing net income or loss, and then taking that income or that loss out of income summary and putting it into each partner's capital account. So what do you need to know? You need to understand that once we split the income or the loss between the partners, you may be called upon to make a journal entry that requires the transfer of the income or the loss to each partner's capital account. And I will show you how to do that. But, you know, as with many other things that we do in this class, these journal entries are forming part of work that was done before in accounting 1, which you may or may not remember. It's okay if you don't, because we'll do it from scratch anyway. And then the other closing entry which we have to do is just like with sole proprietorship, which you had in accounting 1, the partners also have drawings accounts, right? Anyone want to raise a hand and tell me what drawings is or are drawings? Anybody who hasn't spoken, Denise, let me take one of your colleagues. If no one wants to speak, then I'll take you. Hang on, who's speaking?
Oh, this is Maya Cheetah.
Maya, thank you, Maya. Go ahead.
I meant to raise my hand first, but
It's okay. It's a little bit clunky to figure out where to click for what. We'll get there. So Maya, go ahead.
Drawings is taking money out that isn't related to the business.
What do you mean by isn't related to the business?
Like, I remember, like, it's not related to.
Talk. There's no. Don't be shy. Just say what you think, and I'll tell you.
Yeah, I don't really have another way to explain it.
Okay. So, Shafak, I see. Do you want to add to that? Maybe to add to our understanding of drawings.
Yeah, I believe drawings is that when you take money from the company for your personal use. That's
Thank you.
right?
Yeah. So Maya, I think maybe the way you were saying isn't related to the business. You may have been referring to personal use, right? Like you're saying, thank you, Shafak, that's correct. Drawings is a withdrawal, like you're going and taking out money by the partner in the owner for personal use. So I want to take a trip. I mean, I guess in COVID days, it's not as popular, but let's say the owner wants to take a trip with their family somewhere, they need some money or they need to pay their bills. They're taking the money out of the business and it's going to be used for personal, whatever, personal expenses that they are paying. Thank you. So we have partners drawing accounts as well. Drawings is an account that increases on the debit side, right? It increases on the debit side. So when we're closing the drawings account, I know this is you know, a little bit heady stuff here because, you know, does anybody remember anything It's hard to remember the stuff, but I'll see if I can, let me see if I can. It seems, oops. It's the best when like some random robot ends up being the answer to the question. I was trying to show you the drawings account in the textbook, but you know, I'll leave that for another day because it seems like the Wiley website and I are not compatible right now. So the drawings account goes up on the debit side and down on the credit side. When we're closing an account, we have to do the opposite, right? We have to subtract the balance from the account. So when we close drawings, we are going to credit the drawings account to get rid of the balance, and each partner will be debited. Each partner's capital account will be debited. So for the sake of, you know, since I was thwarted by the textbook, I'll just do it over here because we're going to see T accounts as we go along anyway. So I'm going to show you the pluses and the minuses, you know, at the risk of beating a dead horse here, but I think that it's hard sometimes to understand these things in the abstract, especially if you were in the accounting class long ago. So let's just say this is the partner's capital account, all right? Whichever partner it may be. Just like owner's capital when you were in accounting 1, here goes the debit. Debit's always on the left, here goes the credit. This account goes up on the credit and down on the debit, right? What does drawings do to the capital account? It decreases, right? It decreases the account. So when we're closing out drawings, we have to get rid of the drawings balance and decrease the partner's capital account for that amount. If this is the partner's drawings, and again, I'm kind of reteaching things that you guys heard before, so forgive me if you bored by this, but it's difficult for me to show you closing entries if people don't know what we're talking about, right? So
It's a nice
drawings,
refresher. Don't worry about it.
okay, you're like you can be my hype person for the semester, right? Thanks. I appreciate it. So here's the drawings, right? Balance. So let's say the balance on drawings was 2,000. This person withdrew $2,000 over the course of the year. So there's a $2,000 balance. We want to get rid of that balance because drawings, I mean, it's getting into like other, you know, theory, but drawings is a temporary account, which means you have to close it out at the end of every year because otherwise you are going to double count drawings from previous years. So we want the balance to get down to 0, right? That's the point. Where there's now 2,000, we need this balance to be 0. That's the aim. That's the aim of the closing journal entry. So, excuse me, how do you get from 2,000 plus to 0? You're going to have to go to 2,000 minus, right? And that's the closing. That's going to be part of the closing journal entry. So you see here, you credit the drawings to close it, and then you will debit the capital account because the drawings will decrease capital. Why decrease? Because the partner is taking money out of the business for their personal use. So the partner's capital account should show that the account is decreasing because the partner has less of an investment in the business. All right. So what's going on if I lost somebody? Why am I talking about all of this? Because we will be making 1 or 2 journal entries where we have to close drawings and transfer it over to partner's capital. And the way the journal entry runs is debit each partner's capital account for the balance in the drawings account and credit each partner's drawing account for the same amount. And what I just showed you over here is exactly that. You debit the partner's capital for the balance in drawings and you credit drawings. And the reasoning for that is shown because we want to bring the drawings account down to 0. And we want to show that the partner's account has decreased, the capital account has decreased because of the withdrawal. And then the previous one is where we give the partner net income or net loss, and that's just a credit to each partner's capital account. What does that look like? Net income is going to go into, is going to go into the credit side of partners' capital. Okay, so that's the refresher. And as I said over here, we will focus on the last two. Oopsie. We will focus on the last two journal entries, and that brings us to looking at you know, some of these kind of simple examples of splitting net income and net loss, but then the journal entry is also required. Before I move on to example 4, does anybody need me to clarify anything else about fixed ratios or salaries and interest, or even these closing journal entries that I just spoke about? All right, so example 4, right? It's just, we're just gonna move down the line through all these examples and do as many as we can. Held Bond Company reports net income of $70,000. So that's the total amount of income that the partnership earned for the year. We know that we probably are going to be called upon to split that income between the partners. The income ratios, so there's the answer that you need for how to split the money, are that Held gets 60% and Bond gets 40%, right? So you're going to have to apply the percentage, right, to the income number. So the questions ask you for 2 things: indicate the division of net income to each partner and prepare the entry to distribute the net income. So this is a fairly, you know, simplistic example, but the examples become, you know, more involved as we go along. So even though this is a simple example, I'm going to set it up the way we would set up, you know, some of the, I guess, quote unquote, harder examples. So this is example 4. If you're following along on the Google Doc. So let's say that we have Held and we have Bond, those are the names of the people, and we have a total, right? And going back, we know that Held is 60%. And if you want to, you can put the percentages here just to remind you who's who, so you don't end up giving them the wrong amount of money. Then the net income, right? We know that the total has to be 70,000. So you could almost pre-populate that number and make sure that you actually end up with 70,000 being allocated. You can't allocate more than what was earned, and you also shouldn't be allocating less than what was earned. So all you're going to do is say, what is 60% of 70,000? So what is 6 times 7 is 42. So 42,000 is what goes to Held. And then what is 40% of 70,000? So what is 4 times 7 is 28. So 28,000 goes to Bond. And together those two numbers should add up to 70,000. So you know that you've correctly allocated what was available to be allocated. So that's the split of the net income between the two partners. But we haven't actually answered the whole question, because the question also asks us to prepare the entry, and when they say entry, they mean journal entry, to distribute the net income. So if we go back to this discussion on closing journal entries, the entry to distribute the net income is this one. You have to debit income summary and credit each partner's account for the partner's capital, credit each partner's capital account for their share of the net income, or the, well, in this case, net income only. If it was net loss, you would debit. So what do? Go back here. I'll show the whole thing, and then you guys can ask me questions, because there must be at least 1 or 2 questions. Yeah. So I'm just going to do the journal entry. This is a closing journal entry, right? So debit income summary, the account that summarized or recorded, right, all the net income. The balance in that account would be equal to the net income amount of 70,000. And then I'm going to split it between each partner. So Held's capital is, he or she is going to get the 42,000, and Bond capital, sorry, capital, they are going to get 28,000, and together that also adds up to 70. So the dollar amounts of debits and credits balance. This credit over here is increasing the capital accounts, which makes sense because the net income is being distributed to the partners. And since that is money that they made in the business, it makes sense that their capital accounts are going up. The floor is open for questions or for me to explain some portion of what I just did. Happy to do it. Okay, if you think of something, just ask in the chat or ask later. So I just want to say a few things. One, this net income is the ending number on the income statement. So when we get to doing partnership financial statements, just remember that the income statement ends on net income, and that's the number that we are splitting between these partners. And again, this is a closing, and in fact, let me treat it like a narration. This is a closing journal entry to transfer net income to the partners. That's what that is. So when it says make the entry to transfer net income, make the entry to distribute the income to the partners, you're doing the closing journal entry.
So can I ask something small?
Go ahead.
So you credit owner's capital because it went up, right?
Yeah.
And then you debit income summary because it's kind of like income summary is not revenues.
No, it's just.
So under
Income.
what is it?
So it's a temporary account. I mean, it behaves like a temporary account where you are basically collecting expenses and revenue together to see what the ending balance is. So can I show you income summary quickly so that
From the income statement, you mean?
yeah, but it's not the income statement either. Sometimes people call it income statement, but it's not that. So income summary, let me just show it here. I think showing it visually might help, I hope. It's not an asset, it's not a liability. It's kind of almost like a capital account, but not really, because it's an in-between place where we collect revenue and expenses in order to then transfer it to the partner's capital accounts. So income summary is going to go down on the debit and up on the credit. The debit is where you're going to put all the expenses. The credit is where you're going to put the revenue, right? And so in the end, I don't know what the expenses and revenues were for this company. All I know is that we ended up with 70,000 balance of net income, all right? And why do I know it's on the credit side? Because revenue has to be greater than expenses for us to end up with net income. Okay, so it's this temporary holding place for the calculation of revenue minus expenses, basically, but it has the same inside for increase and decrease as partners' capital.
But you said you credit it. So,
Yeah,
so
it's
why
got
is
a
it
credit.
debited
No, it's got a credit balance before you
Okay.
do anything. Yeah, it's good that you're asking. It means you're following. So it's sitting over there with a credit balance. Now we need to transfer the balance to the partners. Okay.
Yeah.
When we transfer the balance to the partners, this account has to end up with a zero balance. The only way to get from 70,000 plus to 0 is to put 70,000 minus. And so that is the closing journal entry. That's why I'm debiting income summary.
Okay,
here.
so because it's a temporary account, you have to close the
yeah.
journal, and that's why you take it down. So instead
Yeah.
of increasing and credit it, you decrease it and you debit it.
Correct.
Because you take it down, but the capital,
Goes
the
up.
owner's capitals goes up, and
Mhm.
that's why it's been credited.
Yeah. You're
Oh.
basically transferring out of income summary, thereby decreasing income summary to increase the capital accounts with the amount of the net income.
Okay,
All
that's
right.
clear. I hope I'll remember that.
It's repetition is
Yes.
the only way to remember it. It's not, the concepts are not what we would call intuitive, like it's not something that you can just understand necessarily the first time, because it's rules based. It's not things that just exist in nature or in life. So you have to memorize some of these things and also practice. All right. So that's why I said sometimes when you make a journal entry, there's like, some large amount of accounting rules that are standing behind the journal entry. So if people get stuck, and if I say you, by you, I mean the royal you, see, not just you, but others. If you get stuck on a journal entry on how to make it, you need to be asking yourself, what am I missing in the theory behind this journal entry that is causing me not to understand why I should be debiting or crediting something, all right? And a lot of the times with this closing stuff, it's because these things from accounting 1, are still a little bit confusing to people, and then they don't know how to make the closing journal entries. We can push on, and I'll do, I'll do the example 5 here. I don't know how far we'll get because we're almost at 12:30 and we end at 12:45. But just to reiterate, this thing about closing entries, and this one also has drawings in it, so that might help again to see how the closing works for drawings. And then after this, right, I know we're not meeting on Thursday, but when we come together again the following week, we'll go more into actual deep allocation of income. So yeah, example 5, assume that AB company has net income of 32,000 for 2018. So 32,000 automatically you should know that is the maximum amount of money that you can allocate between the partners, right? The partners Al Arbor and D Barnett share net income and net loss equally. So that means 50-50, right? They split it down the middle. So if it's 32,000 total, it must then mean that each partner is getting $16,000 that has to be allocated to their partner's capital account. Drawings for the year were Arbor 8,000 and Barnett 6,000. In part A, they are saying, prepare the closing journal entries for the partnership, i.e. transfer net income. Sorry, I think this should say to the partners and close drawings. So when they're speaking about that, they're asking us to do these last 2 steps, right? Transfer the net income and close out the drawings accounts. And again, if you're trying to follow and you might be getting frustrated because you can't always see the question, because I'm toggling between the question and the answer. Remember, all the exercises are over here. So you should just download them for yourself and have them handy so you can follow, because there's not space here for me to do the solution on the same spreadsheet as the question. All right, so for example 5, let's go ahead and see how we do these closing journal entries. And just a reminder, as I set up here, Michaela created a WhatsApp group that people can join if they want, if you want to study together or if you missed something or whatever the case may be. So, make sure that you have that link before you leave the class, because the link won't, the chat isn't going to save automatically, all right? So get the link. So here goes the journal entry to transfer the net income. Again, because it's a 50-50 split, each partner is going to get a $16,000, right? 50% of 32,000. So we will debit income summary. See how it's the same thing as before, right? We debit income summary with the total amount of net income. And the reason we debit it is all the stuff I just explained before. Income summary has a credit balance. If there's income, it's 32,000. When you are transferring the income to the partners, you make income summary 0 and you give the money to each partner. So now I can't remember their names. So it's Al Arba and D Barnett. So now I'm going to credit each partner's capital account, right? So 16,000 goes to Arba, and you'll also see this, I think it's the same example from your textbook. I couldn't get into the textbook just now, and I'm not going to waste time going in right now, but you'll probably see it there again. So this is the closing entry, right? To transfer net income to the partners. That's one part of what we were asked to do. Questions on that, anybody? All right. So now for the second, oh yeah, sorry. Here goes people. Sorry, I didn't give you enough time. Go, Michelle.
Sorry, so it's 16,000 each because we're splitting it in half?
Correct, 50-50. Yep. No funny business. That's it.
Okay.
That's
Okay.
all.
It seemed too easy, that's why.
It is easy. It is easy. The next part of this will be a bit harder because we got to close off
Okay.
drawings.
Okay,
It's okay. It's nice when something is unexpectedly easy.
yeah.
All right. So for the drawings part, if you look here, you'll see that, again, I know this is repetitive, but this is going to help you when you're sitting at, 2 o'clock in the morning trying to do your homework. Look here and you see, what do we do to close drawings? You have to debit each partner's capital account, and for the drawings balance, not the capital balance, the drawings balance, and then credit the drawings account. This is what I was doing, a little bit earlier over here when I was talking about drawings, right? So let's get it together here and do this. So I'm going to debit Al Arba's capital, and I need to look for the amount of Arba's drawings. So Arba has 8,000 of drawings. So I'm saying that because Arba withdrew $8,000 from the business during the year, Arba's capital has to go down by 8,000, and down for capital is a debit. All right, that's why we are debiting capital. And then Barnett, same thing, because Barnett withdrew money from the business, they have less invested in the business. It's like you going to the ATM and withdrawing cash from your bank account, right? You have less money, so that the records have to reflect that. Barnett withdrew 6,000, so I'm going to debit Barnett's capital account with 6,000. Now here we can't combine, on the credit side, we can't do a combined entry and just say drawings, right? Drawings 14,000, because when we are doing accounting, each partner has a separate drawings account because they could be withdrawing all different amounts, and you don't want, like, I wouldn't want, somebody else withdrawing money from their bank account to impact my bank account, right? That doesn't make sense. So in this case, you're going to say Al Arba drawings, and it's the same number, right? We're using the balance in the drawings account for all of this journal entry, and it's D Barnett's drawings, and it's going to be 6,000. And this is the closing journal entry for drawings. And so we've now responded to, I believe, part A of example 5. And anybody questions on the drawings piece? Okay. In the B part, it's asking us to make the T account for partners capital and for drawings. What I'm going to do is, given that the time is tight here, I'm going to do the T account for both Partners Capital so that you can see what that looks like. And then, if there's any time remaining, which I doubt, I'll do drawings. Otherwise, we'll just pick it up there next time. Okay. So prepare the Partners Capital and drawing T accounts. T accounts are the types of accounts that I've just been doing before anyway. Assume that Arbor and Barnett's beginning capital balances are 47,000 and 36,000 respectively. Now, someone raise a hand and tell me a beginning balance for Partners Capital. Is that going to be put onto the debit side or the credit side of the Partners Capital account?
Credit.
Correct. Why do you think it's a credit, or why is it a credit?
Because it's going to be owner's capital.
Yeah, but there's a kind of more specific reason. The balance on an account is always a normal balance on the account, meaning it's not an overdraft or something. The normal balance of an account is on the side that the account increases. All right, that's always the case. So so C is correct to say that the balance goes on the credit side, but the reason that the balance goes on the credit side is that Partners Capital, if I can just go back up and show you, Partners Capital accounts increase on the credit side. So the normal balance on the account will also be on the credit side. So I'm going to do these guys. I'm not going to copy and paste the other capital account because if people are working along with me on pen and paper, it's, I don't want to go too fast. So yes, this is going to be partner 1, Arbor, and this is going to be partner 2. So this is Al Arbor's capital. And then we've got D Barnett's capital. And in fact, you know what? Let me move this up and still show the debits and the credits, right? So debit on the left. Sorry, it's like less haste, more speed. I'm trying to work too fast because I know we're running out of time. So debit, credit. Let me remove this line here because it's confusing. Okay. Okay, you know what? So we don't I don't end up rushing. I'm just gonna do one partner and then leave it there, and then after, next time we can do the rest. So going into the question again, Al Arbor had a balance of $47,000. So per C's point, 47,000, that balance is going to be on the credit side, right? That's the balance for Arbor. Now we have to copy and paste, right? Posting to, in this case, the T account is almost like a ledger, but you've already done all the hard work. You've done all the journal entries, which are the hard work. When you say in a journal entry that you are crediting an account, when you come to the ledger or the T account, you do the same thing. So I credited Arbor's capital with 16,000 over here. So I'm going to credit Arbor's capital with 16,000 as well for the net income. Questions on that? All right. Oh, I see people are talking in the chat. Okay, this is the WhatsApp link. The WhatsApp link is there, folks. So then you see again, Arbor's capital is over here as a debit in this journal entry, right? So if I debit something in the journal, I copy and paste and debit it in the ledger, debit it in in this case, the T account is like a ledger. You do not swap it around. You don't say that there needs to be a debit and a credit. Remember, the ledger is the separate account where you just show, the impact of the transaction on that account, not on every account. So I'm only looking for places that say Arbor Capital. Those are the only numbers I'm interested in, plus the balance that I got from the question. So I've covered everything, right? There's nothing else to post to Arbor's Capital. So now I can add up and subtract and do whatever to get to an ending balance. So let's see, someone's raising their hand. Go ahead, guys.
It's
Denise,
Jay, Professor. So why did you put the 8,000 on the other side?
on the
Why
debit,
not? Yes.
the journal entry is driving what I'm doing in the ledger.
Okay.
That's it. So if I said I'm debiting capital in the journal because drawings decrease the capital account, which they do, so the capital account should go down, then by the time I'm getting to the T account, which in this case is like a ledger, I'm just copying whatever I did in the journal. I've already thought it through over here that capital needs to go down because drawings represents money that the owner took out of the business.
Got it.
Okay. And why did I put, income on the credit side? Because net income increases the capital. We already went through that thought process up here. We don't swap anything around when we have to post. We just keep it the same. Okay, it has to be the same. Otherwise, you're undoing the work that you just did in the journal. And the journal entries are connected to the ledger in that whatever you do in the journal entry, you do the same thing in the ledger. So if you debited something in the journal, you debit it in the ledger going by the account name. That's what's going to tell you which entry to pick. So now I have 63,000 on the credit side and 8,000 on the debit side. So things that are on the same side of the account, we add together. So I'm adding the 47,000 to the 16,000, which is where I'm getting 63,000 from, but I need to subtract 8,000 because that 8,000 decreases the capital. So the new balance for the capital is going to be 55,000. All right, that's how we answer, one portion of part B, and we will carry on with the rest of this next time. Does anybody have a question on this T account before I shut us down here? Okay, I'm gonna stop